speed. So, Mike, you and I have known each other for I don't remember the first time I invested in Aspen. I've made three
It's
investments over a couple of
probably
funds.
2.5 years, almost three
Yeah,
years
yeah,
now.
that's right, something like that. So, what I'd love to do is maybe kick off with, can you walk us through some of the very specific investments that we're already invested in this fund so that people can understand, why borrowers would want to, pay higher interest on debt? Like, what are those reasons? And
Yeah,
then what do these assets kind of look like? So I want to give them a sense of how like over collateralized we are on a lot of
yes,
these things and like why it makes sense. Does that
yeah,
sound right to you? And then
100%.
we'll go into the Q&A. Okay.
Yeah, I think so. Well, I'm gonna share my screen and we'll focus on kind of a few assets where we'll spend a little more time, and then I'll kind of skim through because there's seven and we could be on here for an hour.
Yeah, and let me say this one thing before you get started. Ladies and gentlemen, we have the chat is closed, and here's why. If you look at Zoom, to the right of, on the bottom to the right of chat and share screen or whatever, there's a Q&A section, and there's a little window if you click that that will allow you to ask questions in the Q&A, which is just easier for us to manage than scrolling through a chat. We're just going to be able to, click when we answer them and whatever. So please feel free to drop your questions in there and I can kind of monitor them. So as you're thinking of your questions, as Mike's talking, drop them in there and then we can get to them at the end. Thanks, Mike.
You bet. Well, I'm going to dive right in. We're going to look at
Please do.
asset number one. So this was one that we closed on. So as Walker said, we really like Midwest assets. We are West Coast Missouri, and this is exactly that. So this is Lee Summit, Missouri, is a submarket of Kansas City, and kind of key bullet points here that we're going to talk about is one, asset class, two, kind of what we're seeing frequently as a deal type, and yeah, so we'll dive in here just so you guys got a visual. This is the property. This is a classic value add multifamily property, Kansas City. This is, I mean, I couldn't quite punt a football this far, but it's not far from myself. Ben Frazier is one of our partners. We live right in this area, so I drive by this property. We've been looking at it for a long time, and it's right in the path of progress. There's really nice, brand new A class everything around this, and there's just this one smack dab C class property that is just begging to be improved. So there's a local operator that we know here, and really kind of unique features of this is that the seller was selling this property with an assumable loan. So there's a Freddie Mac loan that was the senior. The positive is that they got 2.94%. The negative is that only covered 45% of the purchase price. So the buyer is having to come up with 55% of the purchase. So a couple things that they can do in this situation. One, they can bring in all that equity themselves, and in doing so, that does, because the leverage ratio is pretty low, it kind of diminishes some of that upside. So what Walker was kind of talking through with you guys is like, when you want to be in that common equity, you want to maximize the back end. And so this is a property where if the leverage ratio is that low, you're really not maximizing the back end. And so this one is one where we stepped in with a $1.5 million check, and we bridged their combined LTV. So combined meaning this 45% senior plus our preferred equity position to a 60% combined LTV. So in exchange for that, here's what we got. So the fund got 2% origination fee. We are getting paid every month an annualized mortgage rate of 8%. In addition to that, every month we are compounding a 6% accrued. So with this, over a 3-year term, that 6% accrued pretty quickly turns into over 8%. And then you combine that with an exit fee on the back end. So this asset's going to make a nice, 18+% return over those 3 years. The beautiful thing about this is that we're at a 60% LTV. So what that means is we have a 40% equity cushion. So that means, hypothetical, they stop they default, whether that's the senior, whether that's us. The covenants that we have in place are one of which, if they don't pay, we have the right to force the sale of the asset. So to cover our interest, we could force the sale, and potentially force the sale at a discount. In that situation, we're covering the senior who gets paid first, covering the pref equity that has to get paid in full before any other equity can get paid. And so that fully protects our position. The beautiful thing is there's a 3-year term on this loan assumption from Freddie. And so they're going to have to refinance in 3 years regardless. And at that time, they'll have finished adding some of the value to increase the value of the property. And at that time, we'll get taken out for the refinance. So this is a deal that we would do all day long. They're already performing fantastic. We closed this back in, I want to say, June of 2024. So we're several months in, and they're already achieving over performer rents. It's moving along really nicely. So yeah, that's a good example of types of assets that we're seeing. And really a lot of these loan assumptions are also unique, that if you want to bring in pref equity, the senior lender also has to approve whoever the pref equity is. And so like a Fannie Mae or a Freddie Mac is not going to work. You couldn't walk off the street and say, hey, Mr. Buyer, I want to give you $2 million and I'll give you a better deal than you're getting with Aspen. Not going to work. Freddie and Fannie have to approve the pref equity, and they dig into our books. They do due diligence on us. It is a lengthy process, and you actually once you're approved, you're in, and so that opens up other opportunities. And there's very few people that are in that can cut, these $1 to $5 million check sizes, kind of to Walker's point earlier. So this is a deal again that we would do all day. We have other deals teed up that are similar to this that will be coming here this year. So that's some touch points there. Some of the things on the operator, what we're looking for, that's usually, questions that come up is, well, what do you do when you look at the operator? So we do a deep due diligence on them. This particular sponsor is somebody that we know. They're vertically integrated. They've got full property management. They've got construction. They've got everything they need. The current NOI meets the combined debt service. So they've got, I think it's 1.2% debt service coverage ratio on the combination of the senior and our pref equity position with as is rents. So they're in a really good position. This is a very conservative asset. I think we would have even lended a little bit more and tried to make a little more, but they're very conservative guys, and we can't fault them for that. Good old Midwest guys. So kind of second here, I'm moving on there. Unless you have any other feedback, Walker, I'll kind of move on to the next.
No, we're doing great. I'm actually hammering out all of the questions in the chat. I'm now realizing I probably should have waited and just done it verbally, but yeah, keep going.
Sounds good. Well, I'll hammer through these. That way we can get to questions quickly. So another asset here, this is an industrial asset in Waycross, Georgia. So Waycross is kind of halfway between Atlanta and Jacksonville, Florida. This is a Class A industrial property, and it was owner occupied. So the tenant was the owner. Their operation had expanded. They needed to move to a bigger location, and so they needed to sell quickly. So what was unique about this is a really seasoned operator. We've been actually trying to do business with them for years, and we just happened to work this deal out. Kind of unique is that they bought this at $52 a square foot, which is 30% below replacement cost, which means if you tore that down and you had to build today, they're buying this at 30% below brand new construction today. You couldn't go build that same exact building for $52 a square foot. No way. So very unique in that sense. They got a fantastic deal on it. They did need some working capital, as well as they wanted to increase the leverage ratio, which is all, again, helps the back end kind of investor IRR. So we came in with a $2.1 million check. We got them up to a combined 75% loan to value. What's unique and why they might come to somebody like us is that private capital like this, private loans like this, have flexibility in terms. And so we get paid up front on an origination fee, but then because this is a vacant property, in the short term, they're not going to have cash flow. So they needed a little more flexibility on the front end. So we kind of lowered their current pay, and then we kind of upped our back end that, again, does compound. and then we got a nice exit fee on the back. So we can really kind of have almost a sliding scale where those things work interchangeably to cover our interests. So this is another one that we feel great about. The asset's already performing. They've already got offers to sell. We're not even a year in. We closed this, I want to say, in June or May. Yeah, May 9th. So they're already off to the races. This is a 2-year kind of projected hold. And we got a nice 25% equity cushion. What's unique about this is that we also have takeover rights. So with preferred equity, you get written into. So Aspen will get written into the operating agreement. Um, we have always at a baseline of forced sale right. So that means if they default, we can force the sale of the asset to cover the senior and our interests. A takeover right would be if there is mismanagement or things like that, we can actually step in and we can take over the asset. So maybe there's not an underlying issue with the asset itself, there's an underlying issue with the manager. So in a takeover, there's kind of two main considerations. Is one, can you take it over and successfully manage that? And so that's very specific to market, that's very specific to asset class. So an asset class like industrial, these are triple net leases. These are things that were set up to be able to operationally take over and effectively manage the asset and exit the asset. So that's a very powerful. These are very powerful rights that we've built in, and because pref equity technically is in that second position, technically is not a loan. It's technically equity. Is functionally very similar because we've built in these rights. Yeah, so that's some bullet points there. Last one here. We'll kind of skim over some other assets, but I think this one tells a pretty good picture here. This is Atlanta, Georgia. This is a multifamily asset that was underperforming, and the senior lender was private capital. So this is a deep value add property. The senior lender was a bridge loan, and they took the asset over from the operator. They then awarded the property handpicked to the buyer. The buyer bought this at a discounted basis, so the lender reduced their basis, or at least they bought it below the lender's basis, and as a result, created a lot better economics for the buyer, and thus us stepping in. So what we did with this asset is we wrote a $1.7 million check. We've got both takeover and forced sale rights. That's a combined 70% loan to value. So again, the senior lender was willing to play ball, and they reduced their position basically. And this operator has more than 20 full cycle deals. They have an impeccable track record. So we have the utmost confidence in them. We did a deep due diligence on them as well. But structurally similar to the last deal, this is a deep value add. So they were occupied when they purchased the property below 70%. And so they had a lot of down units, and so they needed flexibility in terms. And basically, it's a 2-year value add plan. They do have a 1-year kind of optional extension in here, but similar to the last, where we kind of beef up the back end here. We get consistent pay here, and then a nice exit fee on the back. But we also have our takeover and forced sale. Now, some folks might ask us, why would you do? You're in Kansas City. Why would you do a takeover in Georgia? So we've got a lot of relationships because we've been in business for a long time. We've got a lot of relationships on the property management, the project management, construction side all around the country. Some of our key management partners that we use on our assets here in the Midwest operates in Georgia. And so we're set up already with infrastructure to be able to take over this asset, effectively manage it, effectively manage any construction, those type of things. So again, we've got a nice equity cover. It's a combined LTV at 70%. So if we need to force sale or take over the asset, we've got plenty of cushion in there to cover our interest. So again, kind of key things about this. We love Atlanta. It's a great MSA. A lot of growth happening in Atlanta. Sponsor, again, has a lot of strength, a lot of full cycle deals to their name, which is definitely not something you should shortchange. So again, type of deals that we would do all day. And these are deals that banks wouldn't do because the occupancy is going to, agency loans they're not qualified because the occupancy is too low. So we can be opportunistic and take advantage of really great assets that just need really good management and good business plans. We can step in there and make a really nice sizable return without having to take on the full equity risk. I'm going to blow through some of the other assets just so that we've got you've got a sense of some of the other types of assets. This is development in Bentonville, Arkansas. So this is just kind of south of where we're located. We know this operator very, very well. We've done deals with them before. Family-owned company. They've been doing development in this market almost exclusively for decades and have impeccable track record. We have assets ourselves that we own in this area that we operate. So we already have, same thing, property management in place. We've got everything we need to be able to take this asset over. We have construction. We've got development relationships there. So everything we would need to take this asset over, we do have. So takeover for sale is there. We've got a combined LTC, so that's loan to cost, 66%. So we gave flexible terms, but the big kind of unique thing on this is we negotiated a sales price kicker. So on the back, this is an equity kicker, and based on the sale price. So that is a significant number when you're looking at a development project of this size, where you've got hundreds of units of Class A brand new construction. Very, very valuable asset. And so this is going to be, well over a 20% turn for the fund. And yeah, so that kind of gives you some, sense of the flexibility, the types of assets that we might do. Here's some neighborhood retail. These are kind of core plus type assets. Nothing sexy, just boring, but lots of cash flow, lots of steady Eddie type of business plans here. These are mostly lease conversions with kind of light value add in Midwest. These are, smaller
And
multifamily properties in kind
Aspen,
of tertiary
Aspen,
markets.
Mike, Aspen really likes, I don't want to use the word strip malls, but I know Bob is
Neighborhood
really,
retail.
yeah, neighborhood retail. Yeah. Aspen Funds, I've heard Bob Frazier talk about um how he believes that there's a dip in these types of assets, and so he's very attracted to these types of things.
Oh yeah,
Is
yeah,
there
we love it.
anything?
I mean,
Yeah,
basically, they have been building them for a lot. I mean, the '80s was kind of when they stopped building them, and so nothing's
yeah.
really been built. It's not very economic these days, so you see more power centers and big grocery anchored retail. Um, but the neighborhood strip stays really occupied. You got small businesses that service, the local neighborhoods. So you got you're going to have your nail salon, you're going to have your barber shop, your dog washer, your insurance office, some neighborhood restaurants, etc. So I mean, this is what we all see in all of our neighborhoods. And if you really look at it, it stays occupied, and there's no inventory, there's no new inventory. So from a supply and demand perspective, it's fantastic, and you can buy them so much below replacement costs because they're really not. Again, they're not like sexy assets in that sense, and so you can you can buy them at really pretty solid cap rates, do some light value add. They're still triple net leases, so the tenants are paying taxes, insurance, common area maintenance, etc. So you can pass on the majority of this expense to the tenant and just steadily grow the cash flow, steadily grow the NOI, and before you know, you got a really nice portfolio of steady assets that are slower lease cycles. When you got big power centers, there's only so many tenants that can occupy a big space, and so these little ones are so much easier to. The leasing cycle is 6 months or so.
And thank you. That's exact. Like, I think some people that are here with us now might be looking at that and being like, "Man, that looks so boring." And I just want to stop for a minute and say, "That's the point. Like, this is
This one,
supposed to be like just a
this makes me
quiet
salivate. I'm like, oh, that
Midwestern."
asset is amazing.
Like, there is a real estate investor, okay, in the Midwest that owns this building, okay, and all they want to do is improve it and increase rents on their tenants. There's no other place for these tenants to go, right? And there's an opportunity for him to go in and fix it up and increase the rents because they're already paying below market. So the point, and there's no vacancy. So the point is you've got a guy who out there who owns this building who just wants to make a better life for himself.
Yep.
And the only way he's going to be able to get an improvement loan is to go to the private markets, a place like Aspen, and say, listen, here's my deal, here's my structure. We're going to do this really great loan to value for you. So you're like way over collateralized. And I'm going to pay that higher interest rate, A, because you're going to give me the money right? Speed and
Right.
confidence to closing, but also because I can turn that loan around in 24 months or less and have everyone paying. So it's short-term pain for long-term
Correct.
gain for the entrepreneur. Thank you. Sorry to
Correct.
interrupt. Sorry to
100%.
interrupt.
No, no, this is great. I want to speak to the value, so I appreciate that. Another one. This is kind of tertiary market, multifamily. This is classic value add play. We really think tertiary markets are going to perform really well. This is kind of on the border of Oklahoma, Kansas, and workforce housing. So this is another operator who's got a deep track record, lots of full cycle deals, and very straightforward value add play. But we've got um, regional operations that we could take this asset over if we need to. We're making a really nice return on this. If you've got 7% paid, they've got a lot of cash flow as is. This is a fully stabilized property, and so as they come in, they're going to get those rents up, obviously, but they've got enough cash flow to pay us the 7% annualized. Plus, we got 8% accrued compounding monthly. So 3 years sale refinance. It's very straightforward. This is another one that, again, we do deals like this all day, and yeah. So that's I won't go too much more into detail. I think everyone kind of gets the sense. There's a story with all of these assets. This is what we do every day. Walker knows Terrence. Walker knows Ben. Walker knows Mike. This is what we do every day. We dig through all these assets. For every one deal we do, we've looked at probably 100 that we've said no to,
Well,
or 99 that we've said no to, and just
yeah,
cherry pick the ones that make the most sense.
and the thing that I find, so there's two other components that like we don't really talk about that like as I was doing this, I really kind of fell in love with. The first, in no particular order, the first one is that all four partners have to unanimously vote on any asset before it's brought into the fund. If
Yes.
even one of them is like, I don't like it, it does not go through. Ben is an underwriter. Sorry, was an underwriter at a bank before he joined Aspen Funds, where their core competency is really in the private market debt area that they've been doing for 11 years. It's how Aspen was
Yep.
formed. Bob's thesis was how do we become bulletproof, right, and not become susceptible to the volatility in the stock market. And this is where they went 11 years ago. Um, and so Ben, first of all, is a great guy. He's not as awesome as Mike Sullivant is here, but he's a
Of
close
course.
second. And but the thing is Ben is not just a really nice, cool guy. He's also when we got into diligence and when we started, I had a vice president at Goldman Sachs, like asking very direct questions, and the depth of knowledge that Ben in particular, like even questions that went past your underwriter, like like the depth of knowledge that he was able to just pull out and then pull out the spreadsheets and walk through exactly why what decisions were made when was like, wow, this guy isn't just a pretty face. Like this is really engineered. And so that it
100%.
just, yeah, super super confidence building. Mike, how long has Aspen Funds been managing funds?
So we're in year 12 right now, and obviously started in the mortgage note space, doing buying in the secondary market, non-performing, reperforming loans. We've done private lending for a long time through those funds, and that's really where we've built our track record. That's where a lot of folks have known us since the beginning, and then obviously through the years have diversified into some other kind of sub asset types and different investments. So yeah, about 12 years now.
Yeah. And what is the process Aspen is using to source these deals? What are the key metrics used to determine if a deal is worth investing in? I understand there's a lot of nuance around this, but just want to get a broad sense. Nicholas.
Yeah, so I'd say first part of that would be source. So um, one, we've been around a long time, so we got a network of operators because we're operators ourselves. So we got a network of real estate operators around the country that we know well and have gotten to know, and they've seen us, in sometimes in a lending relationship directly with them. In some cases, it's more B2B kind of mentorship type of relationships. But all that to say, they've got a lot of deal flow. And so that'll come to us just directly. Hey, Ben, great to see you in Phoenix last week. I've got this new deal coming up, and I think this might be a fit knowing what your fund does. So that's one way. That's more organic, I would say. We also have a lot of broker relationships out there. So real estate brokers, commercial real estate brokers in particular, debt brokers as well, that bring us, we give them a buy box and say, hey, these are the type of deals. And they say 5 million, 1 to 5 million. They're like, wow, nobody else is doing this. So there's no shortage of opportunities that are out there. So we don't have to go very far. I mean, we've I would say more pumped the brakes on deployment. This is more, hey, let's build sustainably. Let's get into the best assets. Let's cherry pick. Let's be very, very diligent with each one, and let's make sure we can bring the capital and deploy that effectively. So that kind of speaks to most of those deals are sourced through there. When you go on market, there's different components. So most of these are sourced through those relationships, I would say. Key
Yeah.
metrics. Go ahead.
Well, let me just throw one thing in there, which is, like, I'm not saying this to, create some kind of urgency from an investor's perspective, but it is important to note that the cash needs to get deployed into assets as it's coming in. So there is a limit to how much we can bring in every single quarter, right? So
Yeah.
just throwing that out there, if you get towards the end of the quarter, it could be possible that we got to put you on a wait list for, to
Yeah.
wait to get your returns later, et cetera, et cetera. So just planting that seed, continuing,
Correct.
yeah,
Yeah.
process.
So key metrics.
Mhm.
So there's a lot. I mean, that's a loaded question.
There's a
Obviously,
lot.
Walker, you spent a lot of time with us
There's a lot.
before,
Yeah.
going deep. So I would say, bullet points here would be operator. Would want to be one of the operator is where we do a lot of due diligence initially. So I mean, one would be the asset. They say, hey, I've got a deal, right? We usually put that through a sniff test. It's like, hey, this kind of fits roughly in what we're looking at. Who are we talking to? So I would say first and foremost would be the operator. You can have a great asset and a terrible operator, it becomes a terrible investment. And so the who is very, very important. I would start there. So we do a deep dive on their background. Of course, normal background checks. We dig into their deals. We dig into their past deals. We dig into their financials, their balance sheet, their everything basically that a lender would do, like a Fannie Mae or Freddie Mac is effectively that plus probably more. So I I've heard a few akin it to a colonoscopy. So it's not fun for them, but it's necessary for us to cover our interest. So
Hmm.
that would be one. The next would be the asset itself. So past the sniff test, okay, now let's dive deeper. We would take the asset, the underwriting, we would break it up into debt and equity side, and then you stress test. So you test the assumptions, cap rate, exit cap, interest rates, refinance tests, the market itself. So you test all of the underlying assumptions. How well have they modeled in, cost of goods going up, cost of construction going up, rises in wages, et cetera. What are their assumptions on rent growth? There's a lot that you break up. There's a lot of nuance with this, and so this is very, very important to dig into the asset. And then we don't need to be optimistic about the asset. We say we just want to cover our downside. We want to cover our interest. We want to know what's realistic in this asset, and worst case scenario, what's going to happen. And
Hmm.
yeah, so I would say that's fairly fairly comprehensive
It,
there.
it's like buying a business, right? It's sort of
Yeah,
like, who's the management team, what's the industry, like what's the value proposition? You got to do a qualitative evaluation, quantitative analysis, business plan, and then after all of that, and you want to do it, you got to go work out the capital stack and see if it makes sense, right? So
exactly.
and that's sort of the benefit. Also, one of the reasons I decided to work with Aspen on this was, when I went to your office, you have like 30 people,
Yep.
and I've got four. You know what I mean? It was like, okay, I mean, you've got full-time people doing nothing but working for my cash, which
Yeah.
is awesome to me.
I
Anyway.
think I'm going to tell a quick story because I feel like it will drive home the point. So we do all that work, right?
Yeah.
And then that goes to Ben Fraser, our chief investment officer. And Ben says, I like it, I don't like it. Or I like it, maybe we need to push back on X. We come back, the deal comes back around. Okay, I've greenlit this. That goes to the four partners. And like you mentioned earlier, there has to be unanimous consent. We also have an outside advisory board. Currently, one member sitting on there is Anton Matley, who is a very big deal. He places billions of dollars every year in debt. And so he sits on our advisory board and he says, hey, you should do this deal or you shouldn't do this deal. He doesn't vote on it, but he advises. And he's greenlit all of our deals as well.
Hmm.
So there's kind of accountability there. And then a good story would be a deal we walked away from recently. So this is a great asset that it is a great asset, but we got to the finish line. We were getting ready to close it, and we walked away from it because there was concern that the operator didn't have the operational wherewithal to complete. It was a development deal, a residential kind of luxury development deal, and
I loved
they
that
we
deal,
didn't.
by the way. I loved
I
it.
did too.
And then when you guys walked away, I was
I
like,
want it.
nice. I know.
Yeah.
I was
So
like,
it's like
everyone wanted it. So it's great that you guys, reason overcame, greed, fear overcame greed, maybe, or whatever the saying is, right?
100%. Yeah, so I think I mean, for us as being in a lending position, it came down to, okay, so we have to take this asset over. Are
Yeah.
we in a position where we have full residential construction in this region to go and do it? So we probably could have, but what would that have taken away from us? Because we would have had to do a lot of that and manage a lot of that in house. It's a different asset class.
Yeah.
Um, so that's what it came down to, and we said, hey, we can't make a deal. We got to walk away. So it was disappointing, but I think ultimately speaks to our resolve to make sure that every asset that comes in this fund fits exactly, and there wasn't unanimous decision in the partnership. So we walked away.
Awesome. Thank you. I'm hoping I can keep you after top of
Yeah,
the
let's go.
hour and
Let's go.
we can just get the
Let's go.
recording of all the Q&A. All right, great.
Yeah.
First, I want to go to a couple of important, quite not that they're not all important, but I didn't really talk about the NAV, right?
Yeah.
And I didn't talk about the lockup period. Maybe let's do those in reverse order, as well as how long the fund will be operating. I think those are really
Yeah.
important things that I want to slip in here before the top of the hour for those that have to go. Let's start
Yep.
with uh
Length of the fund.
sure.
Yeah. So I think it's hard to say. This is an open-ended fund, meaning we don't have a defined set period of time. As long as we can, it comes down to as long as we can deploy capital to hit the expected returns, the fund will be open. So
I
that
think
could
it's
be
yeah,
evergreen. That could be, I think on the low end, probably 8 years would be low.
yeah.
Um, so we're thinking 10 plus years of life in the fund pretty conservatively
But it's
with
also
the
it's
intention
also
to be evergreen.
yeah, it's also semi-liquid, right? So there's a
Yep.
lockup period, and then, with 90 days, people can request their money back, and then it's best efforts. Obviously, again, answer what's the lockup period, Mike?
Yeah. So 2 years of lockup. And that's why we kind of balance the average life of the position at
Yeah.
around that 2 years. So that way we should have enough internal liquidity from payoff and return of principal that we can meet that liquidity need. So yeah, 2 year lockup, and then it's quarterly liquidity. So you just request it and it'll book to the first day of the following quarter.
And
And yeah,
well, I mean, what's interesting is like assuming the fund hits targets, that minimum lockup means you're going to make, 20 to 24% on your money while Aspen has it paid out in mostly monthly cash flow, which is pretty awesome downside.
yeah,
Anyway, whatever. Um, but so tied up, semi-liquid. Oh, this is what I want to add. Through our diligence, we were able to confirm Aspen has never missed a payment to investors in almost 12 years. Since they started, not meaning that
since
it
we started.
happened once. It didn't happen ever. And second, um, every single time that there has been a request for liquidity, it has been granted with 100% um, efforts. So, you know, Walker, why would you guys do that? It's it's quite simply that we're trying to run a fund, and our fiduciary duty is to all of the investors. And so, like, if you've got a $5 million investment and ask for all of it back, that's hard to do in like 90 days, right? And moreover, if Eastern Europe invades California at the same time that, like Argentina falls into the ocean and everyone's going berserk in the streets and there's like a run on the bank for whatever reason, it's important to all investors that that the fund is held and able to hold those assets and given time to
Yeah,
perform. So it's
yeah,
protection for investors, not um, not punishment for being in the fund, just to be clear.
yes,
Okay.
yeah,
So
100%.
there's a lockup period. Could you the fund is open ended. It's not dilutive. It is accretive. Can you talk
Yes.
about NAV and how it's calculated?
Yeah. So, in simplistic terms, NAV, aka NAV, is net asset value. And so, what
Mm-hmm.
net asset value is the value of your shares. And so, because an open-ended fund, you don't have an end date, you need to quarterly reassess the value of your shares. And so, what that is a combination of is how much you own, and then because all these positions that you saw are also accruing interest
Mm-hmm.
that hasn't been paid in the form of cash, the assets are growing. The accounts receivable from the underlying assets continues to accrue, it continues to compound, and then grow the value of your shares. So that's your take, in a sense, of the ownership of the fund. So that's reassessed every quarter, and so that will, NAV will kind of consistently tick up. And then we do larger distributions. So in 2 years, we've got a handful of assets that pay off. We do a large distribution back of all that accrued interest. That'll kind of reduce NAV a little bit, and then but you'll have assets always kind of circulating, so it'll just keep slowly ticking up, and then that provides you with a fair valuation of what your ownership is in the fund.
So it's
So
kind of a
that's
stock.
basically it's the value of the assets minus its liabilities divided by the number of shares. That's the calculation of NAV,
So it's essentially a stock price.
stock price. Yep.
What happens if the NAV goes down?
Well, we've got a high watermark in the fund. So what that looks at is the last 12 months, and you would get cashed out basically if you needed to redeem, for example.
Yep.
You get cashed out the highest 12-month, trailing 12-month price. That way, it's not diminishing basically where we have an event where there's some drop in asset value or something like that. At kind of a basement, you're looking at par, which would be your capital. So it's a that high water mark is very, very important.
It's kind of like a put option, you know.
Yeah.
But where I was going with that actually was I want you to read my brain, Mike. It was about the GP fees. What happens to the fees if the stock price goes down?
Yeah. I mean, we can't take our split, so we have to.
They stop. The sponsor
Yeah.
doesn't make any money. The sponsor
Yeah.
doesn't make money when the NAV decreases. So the
Yeah.
concept here is that if the stock price is not going up, if the diversification is not accretive, investors are first. Okay.
Yes. 100%.
Um, okay, great. Can I invest in an IRA or 401k?
Absolutely. Yeah. I mean, this is very functional for that. This is, you know, solid kind of low mid-teen returns with very, very little debt. So at this stage, we have a $3 million line of credit.
Yep.
And, we'll have by this year, I expect capital will exceed $50 million. So
Hmm.
do the math on your leverage ratio there. So it's like going to be right around or potentially slightly below what would incur UBIT. So that's usually the biggest concern. So it technically will
That's
generate UBIT, but will
that's
it cross the
yeah.
threshold? If it does, it's going to be pretty nominal. If it doesn't, it means it's just below that because the ratio is pretty low. So
Yeah.
very efficient, and it allows for compounding in the fund. So you can just reinvest the earnings and let it grow. If you're in your traditional IRA, you're probably making, I don't know, 6, 7%, something like that, maybe less in some cases. So this is a great way to almost double the returns, maybe more than what you're making right now.
And just to harp on that, the concept here is you can take cash, okay? But you can also compound your return. And if you compound your return, your NAV is growing internally at a faster rate if you're ratioed of the NAV. And
Yeah.
so your ownership of the NAV is buying more shares. So
Yes.
basically it's compounding faster than if you took cash. And so instead of, the official, 10 to 12% net total return on an annual basis, it increases to 11 to 14% on an annual basis. So,
That's
um,
right.
I think a lot like not to run down this rabbit hole, Mike, but a lot of people really favor liquidity in the stock market. And I've been victim of this. The only thing liquidity does for me is when the stock market goes down, I freak out and I sell stuff. And in fact, if I just didn't do that, then then it would be more like the private market, and there just isn't daily
Yeah.
reporting. So
Yeah.
it's one of these where often I feel like the liquidity factor in certain ways can be overvalued because what you really want to do with stocks is just keep investing a little bit every single month forever and don't touch it. So it's
Yes,
very confusing, and this almost in a way forces that compounding if you're not taking that cash. So
for sure.
what I'm trying to say is in my own IRA, that's what I'm planning on doing,
Good.
in this fund. So, why is now hold on, let me look at the questions. We covered the UBIT question. Um, Covered this question. Mike, can you say more about why you think tertiary markets have tailwinds? What's the thesis there?
Yeah, key markets, of course, but one is competition. There's very little competition, and as a result, there's not overpaying. So you're really valuing assets not on cap rate; you're valuing them on cash flow, effectively. So, and a lot of those tertiary markets actually perform quite well if they're positioned geographically correct. They stayed very, very full. Got a lot of workforce housing. So they're very steady assets. Again, this is nuanced to every market. So I'm speaking generally, but tertiary markets is where you don't have massive competition like a Miami, a Tampa, a Dallas, a Phoenix, all these huge markets. There's just all these large players are playing, and they're having to compete to buy the assets they want. And what does that do? It drives up price, drives down cap rate.
Mm-hmm.
So what we find in these tertiary markets that are close to major hubs perform very, very well.
Um, Great. Can you walk through what investing $50,000 would look like? Um, let's do this instead of. I love this question because she's just trying to form in her head like what exactly happens here. Let's use 100,000 for easier math. Is that
Yeah.
okay, Mike?
Yeah, let's do it. So say we've said unlevered return 10 to 12%. I mean, you think it's going to be higher. I think that is very potential to be true, but we're going to
Well, it's
use
automatically going to be
unlevered.
high. It's automatically going to be higher in my fund. Okay, it just
It's automatically
automatically
higher with
is
you.
because
It's
I'm
true.
taking some of your fee and giving it to the investors. It
That's
automatically is
true.
happening.
You've bought discounts.
So
You've
there's
bought
that.
discounts.
So
Yes.
there's that. But where we're really juicing it is go. I'm sorry. Go ahead.
Yeah. So we'll just say 12. Say it's 12% return annualized,
Because it's
unlevered.
okay. Go ahead. Please.
$100,000. That's annually $12,000 a year in income. Half of that is a preferred return. So that'd be, I think, in yours is a 6% preferred return paid monthly. So
Yep.
that would be 6,000 of your 12,000 paid monthly, and then
Mm-hmm.
6,000 divided into four,
Mm-hmm.
be 1,500, something like that,
Yep.
is paid on top of the preferred, which would come in that third month. So like right now we're mid quarter, so we just pushed out January distributions, February distributions go out in March. In April, March distributions of the preferred return plus that additional annualized 6% for this
Yep.
example's sake will be placed on top of that. So an additional $1,500 on top of what
Yep.
they've been receiving in the
So
750 a month.
So just use the calendar.
The 500.
500
Yeah,
in January, 500 in February, 2000 in March,
that's right.
500 in April, 500 in May, 500 in June, or 2000 in June, like that.
Yeah,
It's going to go like that.
that's right.
Of course, that's hypothetical because
But
January's already
realistic.
passed. This would be
Yeah,
next January. Yeah, but okay,
yeah,
so it would go like that.
yeah.
What happens, and then of course if you yeah, and then what happens if the fund decides to lever? And by the way, since we're talking about it, what does that mean? Before we talk about what it means, what happens to the investor returns?
Yeah. So when you lever, you're bringing in a lower cost of capital that can be deployed to go hit these same level of returns. So, for example, we just brought in a $3 million line of credit. The interest rate on that is, I think, 8.5%. So we're
Yep.
taking $3 million at 8.5% and going to make 20. So we're creating some additional spread that we can distribute to investors. So it increases the investor return. So same thing you would do in a real estate asset. Leverage increases returns. Now, in a debt fund, you don't want to be over levered. So our leverage points are going to be 25% mandated and below. So, I mean, we're going to be pretty low this year, and then that line of credit will grow over time. And so my guess is we'll be in the kind of 15 to 25% range sustainably through the life of the fund. And so that takes, say you're levered at 25%, just for example's sake. Say you're at, 10 to 12% returns, that becomes 12 to 14% levered returns. So you're adding another, 1 to 2% uh, on top of that, because the cost of capital from your debt in the fund is creating additional margin.
Do you know what the interest cost? This is a very detailed question. I apologize. Do you know what the interest cost on your debt is right now?
I think 8.5.
Okay, thank you.
Yeah.
I want to kind of do a live uh estimate. If I you should never do math on camera, especially when it's recording. But and then you've got to figure out what like if we just assume that the gross yield stays the same. Um,
Yeah, just think of it like
Bear
if
with
we're
me.
at 18, 18, 19%
Okay,
gross yield,
let's go
and
with
then
18.
you're at
Let's go with
8.5.
18. 18 with 20% leverage, 8.5. You're talking about in year one, 13.3% cash on cash. Okay.
Yeah.
And then,
And then if you compare it to common equity or investor equity, so that's an
yeah.
easy way to do it too. It's like if I got the bank at 8.5 at $3 million, if I
Hmm.
brought $3 million in common equity, that's say I have to pay 12%, you got a
Right.
3.5% spread there between those two,
Yep.
and then I can spread that difference amongst the investors.
Yeah. And then there is an acquisition fee in year one and year one only. So that same
Yeah,
result in year two, three, four, five, six, seven, eight would actually be closer to 15.5%, which
that's
is
correct.
over that's way over what our slides are even showing. So
That's
that's
correct.
the top secret inside the deal behind the curtain. What I've learned is, sponsors, we say this is the goal, and if that works for you, then let's do it, and then we do everything we can to overperform. So let's talk about. We're not going to talk about leverage because we just did. I just want to point that the way that Aspen is approaching leverage is just sort of tweaking the returns. They're not over levering the portfolio, so to speak, right? And so they're being very, very conservative, very, very safe in how they're approaching it, which is great. And then if you know buy then build and how I talk about things, it's sort of like we're getting that equity build up, in addition to that. Okay.
Yeah.
What happens if an asset doesn't pay?
Well, we talked about a little bit when we looked at the underlying assets. So
Yep.
depending on the asset, you're going to have rights. If you're in a loan position, you're going to have foreclosure right.
Yep.
Um, but for the sake of this question, we'll say prep equity positions will have either or, um, forced sale rights or takeover rights. And there's some additional nuance in there, but effectively it comes down to that. So they don't pay or they violate a covenant of our terms, then we can say, hey, you need to sell this asset. We can force that. We are part of the operating agreement. We have full authority to do that, and we take legal action to do that.
Mm-hmm.
If you had to take over, it's similar process, and we would force the manager out. We would take over that ourselves, and so again, that's all written into the operating agreement for the entity that holds the asset. That's where the rights are. So you've got property 123 Main Street, and then you've got 321 portfolio fund one or whatever owns the asset. So our operating agreements are in the entity that controls the asset.
Yep.
So that's effectively what we would do to cover our interest. So most often that would look like a for sale. If we had to take over, then that would be us taking over the asset, placing our own management, and or controlling the management that's in place.
I mean, I hate to say it, but it's actually better for the investors if everyone in our portfolio fails.
Yeah,
Because of the way the contracts are written, we basically get all of their common stock.
that's correct. We
So
wipe out all
our
their equity
yeah,
and
and
we
then we
make a
get
lot of
the
money as
asset
a result.
and we get the asset. Right.
Yeah.
So that's that we talked about risk adjusted returns. That's sort of
Yes.
the approach there. Um, why is now a good time to invest in credit? We kind of covered that, but do you have anything to add?
No, your slides were fantastic. I mean, there's you saw the cycles, right, of the Great Recession and COVID, and now seeing that cross the threshold basically. So it's a dislocation in the capital markets, and it's not going anywhere in the definitely in the near term.
Yeah.
We think probably longer than people want to realize as well. The
Hmm.
interest rate environment with the changes with Basel III coming, this
Yep.
is going to be tighter than most people think for longer, and it's the perfect time. And with our fund, there's very little competition, so we get to continue to cherry pick for as long as we want.
I mean, yeah. I mean, I showed a lot of that data earlier. I mean, basically, BlackRock came out and said like this is going to be the number one risk adjusted asset class for the next 5 years, period.
Yeah,
So let's just roll there. And by the way, if you look at the other top three or four, they're all the things that, we invest in at, Build Wealth and the buy then build strategy. So
yeah,
it's what rich people have always invested in for decades and what we now get to do also. Okay.
yeah.
Um, again, we've covered some of these, Mike, but I'm gonna throw some of these at you. What's the advantage for the borrower to go to a private versus conventional business loan with a bank they may have an existing relationship with? Sorry, maybe a dumb question, but some of the short-term interest rates seem high. Relatedly, how does the private credit market change with Fed rates staying the same or getting cut? Good.
Yeah. No, I think
Good.
it's a great question.
Yeah.
So I think two things. One, they can still go to those banks, but the banks have tighter credit lines. So where they might have been lending up to 75% of the purchase price, or some cases 85,
Yes.
now they're at 60, 50, 65,
Yeah.
55. I mean, they've significantly lowered the ratio at which they're willing to lend.
Yep.
And if there's a first position, no bank is going to come in a second position. They do not lend in second position on an asset.
Correct. You have
So
to wipe out the first one and then they take over the whole senior. Yeah.
exactly. So they will not do that. So there's no other solution. This is the way the system works. And so they're a bit captive in that sense. And yeah, so I think the other part of the question, what was the other part of the question about? Uh, I
If the
blanked on that.
federal, if the Fed rate goes up or down, what happens to private credit rates?
I don't think, I mean, it certainly can affect, ratios of how much how much those credit lines are willing to extend. I don't think we'll see that in a significant way. If they go up, I think maybe they could extend that up a little bit higher, but there's still going to be a tightening for quite some time. So I think the sensitivity of what it could do is make some assets less desirable for us to deploy into,
Hmm.
potentially if there's not sufficient debt service coverage, things like that. So I think some deals are going to get harder to pencil, but I think most of that is just going to get fleshed out in the valuation of assets. People are not going to pay as much for the asset. So by the time it's coming to us to trade, we've already valued the asset as is today, and we're coming in with a forward looking kind of conservative estimate of performance and the exit. So it's really, I can't say the interest rate environment is irrelevant, because it certainly is relevant, but as it relates to what we are doing, it's I don't competition in our uh, competition in our sector is likely what would change the yield that we could get. So it's either the bank increasing the amount of ratio that they would lend, or it's more competition where we're having to give a little to make a deal happen.
For me, I feel like the easiest to understand version of this, right, is like someone owns a, neighborhood retail building, okay? That, they refinanced. Yeah, you're drooling. they refinanced when rates were like zero, right? So they've got this 25-year loan at like 1% or whatever. And now they want to go in and improve the space so that, they can increase rents with their people, right? They're not going to
Yeah,
go back to the bank and say, "Hey, take out my low interest loan and give me more money against my asset. Give me more money
yeah,
against my collateral, and then I'll pay off some of it later after I increase the rents because I need more money for improvements." They're going to go to, some version of a bridge loan, right? Or an improvements loan in order to get that done. And that's where secondary loans are made, right? So I think that what's the point? The point is like just look at everyone who took a home mortgage when rates were zero. They're not moving. They're not moving, right? And so it's sort of like, well, where can I go get debt without removing this like solid gold loan that I have?
yeah. And if you get flexible terms, so as long as you can maintain the debt service and you're going to add that much value in that short amount of time, it's like, who cares about, you know, I'm going to make, 25 plus percent on this asset. So I don't really care that I'm going to go pay 16, 18%
Mm-hmm.
to this person because they got the deal done. So what we see pretty commonly is like, hey, I raised what money I could raise, and now I've got money hard in the deal, and I need to get it closed, and I need 2 million bucks.
Mm-hmm.
Can you help me? And we're like, yeah. So that's that's also kind of behind the scenes of what's happening.
We have a lead here in the question, so I've told them to send me an email with their deal. We'll get
Okay,
that looked at.
sounds good.
Okay, so let me run through some of these that I sort of answered through. Oh wait, someone asked, what is a tertiary market? What defines a tertiary market? Um,
Yeah, I
Population?
mean,
Go ahead.
yeah, population is generally what's driving that. So these are generally close to major markets or near kind of mid-major markets. Like Kansas City would be considered kind of a mid-major market. So this
Mm-hmm.
would be a market like, if you know the Midwest, it'd be like Wichita or Topeka. They're pretty close. Or if you're in St. Louis, it'd be like
Columbia.
Columbia. Yeah,
Yeah.
markets like that are tertiary. They're not
Springfield.
primary
Yeah.
markets. Yeah,
Springfield is like the third largest city in Missouri, and there's like no airport. And it's like there's like
yeah,
colleges
exactly,
and Bass Pro is headquartered there, and like
right,
you can't fly there. Trust me, I used to own a
exactly.
business there. I can't get there.
Can't get there. Gotta drive.
Right. But okay. So Mike, do you have a little more time? I promise we'll be done in 9 minutes. I see you looking at your
nine
family in the
minutes.
distance. Okay,
No,
let's
no,
just
you're good.
hopefully we can hammer through these. So, okay, we did that. The slides are included in the data room. There's a couple new ones I slipped in there today. I'll make sure I get those in there. What can an investor expect? We covered that. What does Aspen and Walker's fund take as a fee? Um, get into the PPM, call investor relations. All returns that have been presented are shown net of fees after all fees. There is a uh, acquisition fee in the first year, and then there is a assets under management fee that pays for investor relations, accounting, legal. I get a little something for my effort, I hope, at the end of the day. Ads, growing the fund, all the rest of it, and then also like the 30 people at Aspen that are working for you full time, making our money make money. So that's what the fees are for. They're in my analysis, I look more at the returns. Thank you for asking about the fees. They're there. I love your book. Okay. Hey, Walker, I love your book where you talk about the upside potential of running your own company, but this is passive investment. What's the roadmap you recommend? Should I first buy and build or start with these passive investments while I search? Is there an ideal path? Okay. I think, sorry, Mike, this is, but like, it's important to me you understand. Like, so I started raising for in things that I was investing in about a year ago. Okay. And I always got this question over and over and over, which is Walker, what are you investing in? Can I invest with you? Like, what can I buy that you're buying? Like, all this stuff. And then when I started going out and say, hey, I'm investing in this. Do you want to invest? I raised like $4.5 million in a day. And I was like, okay, there's a desire. This will be fun. Let's start finding the things in, my version of what I call the wealth stack and diversify into the private markets with trends that are happening with operators that are exceptional. And it's like when I show you the IRR that internal rate of return that is currently unrealized that I've gotten for my investors over the last 12 months. I can't say it out loud because it's actually ridiculous. The first portfolio, we're up 49%. The Dallas plant, we're up 63%. We closed around in December with a ground up building. So I still mark that as a zero. And like we're already up on average, like in the 30s, right? So what I'm ultimately trying to do is get people similar returns to buying businesses, but not having to actually, be active. So they could still go out and, keep, that job that they have with those golden handcuffs that, pays, pick a number, 250 to 700,000, whatever, kind of range, where they don't necessarily want to take the risk of buying a business, but, can build those assets faster for them through the wealth stack. And again, my whole mission was to, the people that go from, listen, the people that go from 1 to 5 million to 20 million is like 0%. It's not like 1%, it's zero. Okay. And the truth is you can get there by mirroring the ultra high net worth portfolios in the private markets and cherry pick the supply demand imbalances and go tackle them, right? Not everything is going to be one of these like private equity 63% in 6 month kind of things. And again, it's unrealized. There's still risk involved, right? Whereas something like this is just that basic, let's be the bank version of reality. We're going to over collateralize. We're going to get cash every month, right? And, like this is how you build financial independence outside of your job. You have a job, you invest in the stock market. You own a business, you invest in private credit funds. Like that's the parallel. And I'm trying to open your eyes and expand everyone's knowledge and access to the private funds with things that I'm personally investing in. That's my mission. Okay, that's what we're trying to do here. Mike, apologize for the
I
lecture.
love it.
Great.
I agree.
Thanks. Yeah. What's the advantage for the borrower? We did that one. Investors from Canada, welcome to sign up. Yes. International investors are welcome. Everyone needs to be an accredited investor. And Mike can talk to you, but my knowledge is I'm still learning this particular aspect, but we have had investors from Canada. We've had investors from Europe. We have not had a problem. Everyone seems to have some version of that accredited investor status, and so we just work through that with you. Um, Tertiary markets process for Aspen, covered that. Will there be a replay? Yep, that's why we're recording it. Thank you for your interest. IRA, yes. UBIT, no. Glad you covered the. Okay, great. What defines tertiary as an operator focused? Okay, that's a lead. Okay, great. Mike, thank you so much for your
We
time
did it.
today.
We did it.
Yeah, we did it. I really
I need to
appreciate it.
do I need to do my are the
Nice.
yes.
Yeah, I mean, again, I think that all private investments, they're either income focused or appreciation focused, and or sometimes you get that blend, right? And this is, often when we look at, when you read Rich Dad Poor Dad, and you're like, I'm gonna go do real estate investing, you're looking for that 1% rule. I want that, something that's gonna pay 1% every single month. Guess what? This is that. This hits the 1% rule. Okay. Just
Yeah.
if that wasn't obvious, making that known. Number two, when you buy a business, you're looking for something that's going to pay between 10 and 20% seller's discretionary earnings. Guess what? This hits that too. So, it's one of these where it's a completely passive version, but it makes your cash work for you in a way that is safer than the stock market because it's lower in the capital stack with statistically and historically higher average returns, also paid monthly or compound higher. That's why I like it. Mike, any final words?
Love it. I'm so grateful to have been invited tonight. So grateful to be with you, spend time with you, and excited to do some more investing together. It's going to be a great
Super
year
excited.
and beyond.
Yeah, super excited. And just so everyone knows, you are only 3.5 hours away from me, and like my Tesla drives pretty fast, so I can get there. And I know your Starbucks. So if we ever
That's
have a
true.
problem,
You
I'm gonna
do.
show
You
up and
stole
I'm
my
like,
phone. You stole my phone.
let's not tell anyone that.
Okay. All right.
Robert, I see you. Thanks for being here tonight. Mike, thank you so much. Thanks everybody. See you on the inside. Let's go stack
Much
cash.
love.